Um, I want to tell you also, our next speaker is a national speaker, Ms. Shari Olefson. You probably have heard about her on CNBC, or you might have heard her on Fox News. But she is the author of Foreclosure Nation, and she's also her new book just hit Barnes & Noble and Amazon this week. It's Financial Fresh Start, and it explains how the average American can prosper in today's economy. At the very end, I urge you to stay because we will have a raffle, and in that raffle, we will be giving away Ms. Olefson's books. So autographed, mind you, they're autographed. She is our next speaker. She is also, not only is she an author, her real job is, she is the actual director for the Carnegie Group think tank, and she's a lawyer in Florida and Washington, D.C. for over 25 years. Welcome, Shari Olefson.
How's everyone doing? Do I need the mic?
No.
Yes?
Yes.
I should be done. How's everyone doing? Good, good. Thank you for coming. I'm going to talk about the new regulatory reforms, but also legislative reforms. Does anyone remember those Schoolhouse Rock segments that used to be on Saturday mornings when we watched television, and they would talk about a bill sitting up on Capitol Hill? That's the legislative process, which is as animated as those cartoon segments were, and sometimes very painful. So we're going to talk about that, and I can promise you that what I'm telling you is current through yesterday morning, because things always change in Washington, and I was just busy yesterday, so I didn't check this morning, but it's current through yesterday morning. If you can just indulge me for a moment and think back to about 10 years ago, and raise your hand if you knew someone who was in foreclosure 10 years ago. One person, two people. How about now? Raise your hand if you know someone who's in foreclosure now. As the mother of two teenage daughters, my daughters are 16 and 18, I often wonder if we got together, the same people in the same room 10 years from now, and I said, raise your hand if you know someone who's in foreclosure right now. I wonder how many people would raise their hands. Because we have all these new rules and reforms now that are supposed to prevent that. The question is, of course, are they going to work or not? Has foreclosure really become a way of life, or was it just a temporary situation? Because remember, a lot of these rules we have now are permanent. So this may just be, and it'll be up to you to decide when we're done with this little segment today, whether some of these new rules and reforms are really an example of be careful what you asked for, because we're really creating a permanent structure to deal with foreclosures forever. The good news is, again, there's no shortage of new rules and reforms designed to prevent a problem like that. For example, and here's slide one. We get to see if I know how to use this. Nope. There we go. Raise your hand if you're familiar with Dodd-Frank or you've heard of the Dodd-Frank Act. Okay. Well, in a nutshell, and I'm going to try to just distill this stuff for you because it can get real dry, so I promise you that it'll be 30 seconds and what you need to know about everything for each of these topics. In the Dodd-Frank Act, there were really three goals. One was to create stricter standards and supervision to prevent other taxpayer bailouts. The second was to create an advanced warning system for bubbles and crises, so we'll see it coming if that's really even possible. We know that in South Florida with our hurricane warning systems. I mean, we know, but you're sitting at the edge of the seat until the last minute. Hurricane Andrew was supposed to hit Hollywood, and look what it did to Country Walk. So you just never, no advanced warning system is perfect, is the takeaway from that. And then the third was to improve the regulatory agencies, if that's even possible, because government is government and regulators are regulators. There was also a series of deadlines under Dodd-Frank which rolled out in 2010, and one of those deadlines, these were deadlines to get rules written and to then implement them, and one of those deadlines was actually just 2 weeks ago. So there were like over 2,000 pages worth of new regulations that had to be finished by the second or third week in January, which were. So we'll touch on that a little bit. Anyway, the bottom line, and what I think is really important for most Americans, and certainly most of us in this room, is so far, the outcome that we know from Dodd-Frank for sure is we have thousands of new pages of regulations for sure. We have hundreds of new rules, about 250 new rules for sure. We have several dozen new studies that are required periodically forever, for sure. So those are studies that your tax dollars are going to have to pay for. And we have at least 2,500 new staffers in government, for sure. Those are the absolute definite outcomes so far from Dodd-Frank. We know in the first year, it cost almost $30 billion to gear up because of the Dodd-Frank Act. And supposedly, moving forward, it's going to be about $22 billion a year for the top financial institutions to adjust themselves to this new regulatory climate. And we know that when banks or financial institutions have costs, eventually they pass that on to us in form, our free checking goes away, things like that. Big investments, big dollar investments. If it works, it will be worth it. So we'll have to wait and see. Now, in terms of the regulatory reforms, obviously there's a lot more than just Dodd-Frank. Some of those you may be familiar with. I'm going to talk to you about them in terms of 3 buckets. We're going to talk about the real estate and finance bucket of new rules and reforms, and this is the biggest slide, so don't freak out. There's 7 things on this slide. The rest of them are much smaller, and I promise less than a minute on each of these things. We're going to talk about this, then we're going to talk about tax issues, and then we're going to talk about the bucket that I sort of call other. No doubt, because of all the stories that we've heard about foreclosure, some of these really heart-wrenching stories, foreclosures and foreclosure alternatives have been sort of top of mind, not only for the media, but also in Washington. Everyone's familiar with Making Home Affordable by now, and HAMP and HARP and HAFA. Okay, so why do these foreclosure alternatives and foreclosure rules matter to you? Well, of course, they impact home sales. These rules are going to impact home prices, and they continue to impact foreclosures and inventory and whether you can get your short sales done or not. But they also impact public perception of the housing market in general. So, that can have very long-lasting impact on public perception. Way after GDP goes up and our employment numbers look better, those perceptions that we create in the general public about home ownership linger for a long time. By show of hands, how many people do short sales on the buyer side? And what about on the seller side? And both? Most of you guys do both? Okay. So this past August, the Federal Housing Finance Authority, which of course is the conservator for Fannie Mae and Freddie Mac, who we know hold most of the loans in the country, told those 2 agencies that they need to issue new guidelines for short sales to improve the short sales. That's probably the biggest piece of regulatory reform under foreclosure and foreclosure alternatives are these new rules designed to speed up short sales and those kind of things. So they go to the response time, they go to things that the banks and the servicers have to do. Have anyone noticed an improvement in the last year or so in the short sale process? Okay. Yeah, most people will say that thanks to these rules and reforms, it is speeding up. A lot of them they've been passed but not implemented yet. In other words, they may pass them today, but the effective date is not until another 6 months because they know that people in the industry need to gear up. So one thing you will be seeing is continual improvement in the short sale process in the coming months. The second category is loan servicing. Everyone's familiar with now loan servicing. Another kind of irony, 5 or 6 years ago, who the heck knew what a loan servicer was, right? We didn't really need to know. Why does it matter to you, the rules and reforms in loan servicing? Well, they impact homeowners' ability to save their homes or their credit or both, and our ability to help them get deals done and to preserve neighborhood values and to basically, in a big picture, our ability as realtors to help navigate the country out of this situation, this slow economy, because it's been proven historically that economies don't recover without housing. Now we've got new rules and reforms, some of which were just passed about 2 or 3 weeks ago, that require servicers to speed up what they're doing. They require servicers to correct errors quickly, to provide information to homeowners quickly, to force place insurance. Anyone had someone who potentially lost their home because of force place insurance? It was a big issue down here in Florida. Now they're required to justify that and to correct it right away if they were wrong. Evaluate borrowers' applications for loss mitigation within certain time periods and those kind of things. By show of hands, how many are familiar with QM or QRM? Anyone ever heard of those terms? Okay. A couple people. Mostly people in banking have heard of those. Why do they matter for you? Well, QM stands for qualified mortgage. QRM stands for qualified residential mortgage. They sound really the same, right? But they're very different. They're both terms under the Dodd-Frank Act. The reason they matter to you is that these terms and these new rules could potentially impact the availability of less costly loans for your buyers. So this will have an impact probably as early as next year, on the types of loans your buyers will be able to get. And here's the 30-second version of that. QM goes hand in hand with a term under the new Dodd-Frank regulations called ability to repay. Banks from now on are going to be required, before they make a loan to anyone, to make sure that that borrower has the ability to repay the loan. Now that's something, I mean, how many people thought it was up to the borrower to make sure that they had the ability to repay it, right? Under the new laws, that obligation is being put on the originator. Now, in order to do that, the bank needs to show that they made a reasonable good faith determination of the buyer's ability to repay based on things that are common sense to us and that banks have always looked at: income and assets, employment status, credit, those kinds of things. If they do that, if they follow these new rules on ability to repay, they will have a presumption that they followed the rules. So we're going to see banks trying, it's basically a safe harbor. So we're going to see banks wanting to follow these rules so that the mortgages they originate are called qualified mortgages, which means that it's going to be harder for your borrowers, your homeowners, your home buyers, to get any loan that doesn't meet this definition, okay? Now something that, and one of the assumptions under the qualified mortgage rules is that your loan has to, the loans that are forbidden to fall under that definition include interest-only loans, negative amortization loans, balloon payment loans, loans with a 30-year term, more than a 30-year term, anyone with a debt-to-income ratio of more than 43%. So those, anything that falls under those categories, which, you know, sometimes, particularly down here, those were the loans that helped get, you know, borderline buyers into homes. Your buyers are not going to be able to get those loans anymore, or they're going to be very expensive to access. Now, what qualified residential mortgage means, and remember, this is under a whole different category. This is for lenders who securitize their loans. In other words, they initiate the loan to your customer and then they sell them. We've all seen that, where they sign the assignment of mortgage at the closing table and it's sold to another lender. This new rule says that unless you're doing, that you have to retain 5% of all those mortgages you sell. Now, lenders don't like to do that because they make business buying and selling loans. They want to get the risk off their books. They want to do mortgages that they're going to be able to sell all of them. They don't want to have to keep that 5%. So this new rule says as long as the loans that you originate fall under what we call a qualified residential mortgage, you're not going to have to keep that 5%. So we know that banks are going to try to do loans, which again are going to be these less risky loans, that the government considers a qualified residential mortgage, so they can sell them all. So if you've got buyers, those borderline buyers who need to do what the government now considers more risky loans, it's going to be more difficult for them to find a bank that's willing to do that. That's it for QM and QRM. That's all you need to know. That's why it matters to us in this room. The Federal Housing Finance Authority also has been very busy this year with Fannie and Freddie. One of the things that's come up that could potentially impact Florida is what's called state-level guarantee fee pricing. Has anyone heard the term G-fee? That's the fee that once the bank makes the loan, when they want Fannie or Freddie to buy it, they have to pay Fannie or Freddie to get Fannie or Freddie to buy the loan. One of the things that's happening now is there's discussion about, normally it would be that fee is the same across all states. There's discussion now, though, to make that fee higher in certain states. So basically, the cost of doing a loan would be higher in those states. And guess which one of those 4 or 5 states is? Of course. And it makes sense. It's tied to, you know, the losses that are incurred. So the point is, as we see discussions on state level G-fee pricing unfold, that's something that you guys want to pay attention to, because it will end up costing your borrowers more money for their loan. And one of the things we see, especially with those folks who have little money available, is when their costs are higher to close, who's the first person they come to and ask for you to kick in part of your commission to help cover these costs. So even though some of this sounds a little removed, indirectly within the next couple of years, it may actually impact your income. The other biggie is the GSE, and you know, GSE, the term GSE includes Fannie and Freddie, the GSE reform in general. And that's something the government's been talking about for a long time, because so many folks sort of blame Fannie and Freddie for the real estate crisis and big parts of it. We don't need to get into that discussion, but there's been a lot of discussion about reforming the GSEs over time. So, and that could have a huge impact, again, on the availability of loan money for your borrowers. It would have a huge impact. Just recently, there was a strategic plan released for how to deal with Fannie and Freddie over the next couple years. They've been encouraged to wind down their portfolios quicker than before. Other changes that indicate that overall reform is coming quicker than maybe some of us first thought. So that's another area that you want to pay attention to potentially in the news. How many people do FHA loans, deals with FHA loans? Okay. How many people are doing more FHA loans now than like 5 or 6 years ago? Yeah, of course. And recently, we have heard in the news that FHA is having solvency issues because of all these losses. Now, why does that matter to you? Again, when they've got to cut back to cut losses, that means less availability of credit to us. One of the big issues here in Florida is FHA with the condo rules. We know that condominiums can be a little more risky because of the problems the associations have. So we know that if FHA is having solvency problems, condominiums are seen as more risky, the chances of them really embracing loans for condominiums are a little less clear. So that's something else we want to kind of keep an eye on. The other biggie, I don't know, do we have any loan originators here? People who also originate loans? A couple. Reverse mortgages got really big after the bubble burst because it was one of the few areas where you could still actually do closings. FHA is cutting back effective April 1st. There's certain types of reverse mortgages they will no longer be giving. So whether you do originations or not, or maybe you live in communities where there are some older folks, they're going to have less choices in that regard because FHA is having solvency problems. How about VA loans? Anyone do VA loans? A couple people. So VA recently reinstated the higher VA loan limits, and they also made the VA ARM program permanent, which is helpful for us who are trying to help veterans get homes. For the loan originators too, you know, under Dodd-Frank, for the loan officer compensation, there are some new rules that change how loan officers can get paid as well. How many are familiar with, remember a couple years ago, the HUD-1 form and the good faith estimate forms changed? Okay, so that was really under RESPA. Everyone's familiar, of course, with the Real Estate Settlement Procedures Act, even if you haven't read about it since you took your real estate licensing class, we all heard about it, and the Truth in Lending Act. Those were revised a couple years ago, and these new forms came out. Raise your hand if your borrowers or your buyers had an easier time understanding all these new forms. Nope. Okay. I'm not raising my hand either. Well, the Consumer Financial Protection Bureau is toying around again with RESPA and Truth in Lending. And one of those things they're looking at mostly is combining those disclosures, so playing around with those forms again, but also on high-cost loans. They're really paying a lot of attention to high-cost loans, which are typically loans for, again, more borderline-type borrowers, the borrowers that maybe we used to call subprime borrowers. And one of the new requirements is that folks like that are going to have to escrow for their loans for at least the first 5 years of their loan, which is, that escrow is not actually a cost. Those are monies that you're going to have to pay down the line, but having to do a loan for sure with escrows and not being able to waive those escrows is going to also have an impact on who you can sell houses to and when. That is really it. The last category is Basel III, which are banking rules and reforms, and those relate to how much the banks have to keep in reserves. And again, those numbers are being played with still by the Federal Reserve and the FDIC and the OCC. So when banks have to keep more money in reserves, they just generally pull back a little bit on their lending. All right, next bucket is the tax issues. Anyone heard of the Mortgage Debt Relief Act? That's my absolute favorite. Did anyone here was anyone involved with folks who did a foreclosure or short sale before the Mortgage Debt Relief Act? And did they get hit with a big tax bill that they weren't expecting?
Yeah, we got rid of it, yes.
Okay, yeah. To me, that was just horrific. I mean, no one had any idea that was coming, and talk about jumping from the frying pan into the fire. Anyway, of course, George Bush signed the Mortgage Debt Relief Act, which was wonderful, and thank God it was extended as part of the fiscal cliff deal till the end of this year, because otherwise anyone who's been working on a short sale would have had to have a whole new conversation with their sellers. So now we have until the end of this year, depending on what the market looks like again, and also, of course, what the budget issues look like in Washington, it might get extended again, but that, I think, was probably one of the smartest things that happened in the last month or so. Anyone familiar with the mortgage interest deduction? Okay. One of the things that's interesting, raise your hand if you think the mortgage interest deduction is a deal maker or a deal breaker for homeowners.
Could be.
I used to not think so, but one of the things that's happened recently, since it's been sort of in discussion, because they are looking at it in Washington as something to eliminate or reduce or cut back, is that it's been on TV a lot. And one of the things I found is anytime I've done something on CNBC or Fox or something like that, usually the camera guys are guys, they're young guys, and we'll tape a segment, and as soon as we go off air, someone in the room says to me, they're really thinking about getting rid of that. If they get rid of that, I'm walking. I can't stay in my house if they get rid of that. Every single time. And it just amazed me because I didn't think it was that significant for people, but it really is. And everyone here presumably is a member of the National Association of Realtors, which is just, I mean, the way they represent you in Washington is absolutely incredible. And they're fighting very hard to preserve the mortgage interest deduction for homeowners, which is a deal maker or breaker for everyone in this room. It's a reason that people buy homes still, whether you believe it or not, it really is. Also, the capital gains rules, and of course the ability to write off your real estate property taxes are the primary tax issues in the tax bucket. Those will all be under consideration in Washington this year, because one of the things that's happened, and I like to look at just the big picture, because sometimes drilling down in this, you lose people. If you look at the big picture, that's all you really need to know. The last couple years, it was all about finding the bad guys who caused the financial crisis and blaming them and punishing them, and all the politicians wanted to get credit for catching the bad guys for you, and everyone on the media wanted to get their ratings by telling you how bad these guys were and all that kind of stuff, and tons of professionals wanted your business to help you get even with the bad guys, stuff like that. Well, now that we have all these rules, what's really coming into the limelight now is the country's budgetary issues. I mean, we've been hearing at least as much about the debt crisis and the fiscal cliff and those kind of things. So one of the things we're going to start seeing is more of a shift towards this bucket. So if we were to meet here next year, I would expect this slide to have 7 items on it and the last slide to have 3 or 4 items, which is something that we need to be aware of, because these tax issues will impact people's ability and interest in owning homes. In terms of the other bucket, which is actually our last slide, the biggie for us here in Florida was that this past year, the National Flood Insurance Program was extended for another 5 years. So people who live in flood zones who need flood insurance to get their mortgages will be able to do that. That impacts 21,000 communities around the country and almost 6 million homeowners and businesses, which is big for us. The other thing is that there's a lot of discussion in Washington now, especially since Hurricane Sandy, about a national disaster insurance policy, and that's something we may want to keep our eyes open for, because insurance happens to be another big reason, not so much if you live in Florida and you work here and you need to own a home, but it is another big reason that people from other states are not buying here, because they know our real estate taxes and our insurance is so high. So certainly a national disaster policy would help. It would also help actual homeowners and all of us should there be another Hurricane Andrew or Wilma, because our costs would be lower. Our insurance wouldn't be skyrocketing through the roof. Ron Klein, a representative from here in South Florida, had presented a bill a couple years ago when he was in office. It's being looked at again, and maybe something that you want to follow, because it would certainly help us bring new potential buyers into our state if we could spread that cost around. And the thing about natural disasters is it's not a coastal issue anymore. All you need to do is turn on the news and you see it's not just about hurricanes in Florida. It's about tornadoes and earthquakes and hurricanes in New England now, or New York. So it's more open to the nation sort of spreading that cost. The other bucket is appraisals. You all have probably had issues getting properties to appraise, but the other big area here is on those high-risk loans. Remember the ones that used to be subprime buyers? The appraisers are now going to have to physically always go in and physically inspect the property. The home buyer is going to have to get a copy of that appraisal, and there were a whole series of new rules on appraisals that were just recently passed this last month, come into effect a year from now. So we'll be seeing that make a difference for us. Anyone do EB-5 deals? Not really. The EB-5 was reauthorized for another 3 years. Section 8, housing is another kind of interesting area, anyone do rentals? A couple people, okay. We know that there are 2 million more rental households renting in this country now. We also know rent rates are going up through the roof. In Miami, it was over 10% increase last year in rent rates. So there was a bill this last couple months to help privatize Section 8 housing, make those vouchers available to more people. It did not pass. But I would expect, especially for folks who do rentals, that we're going to see more legislation, because there's just more people renting, and rent is becoming more unaffordable. For folks on the lower end of their earning spectrum, some of them are spending more than 50% of their annual income on rent, which is just not sustainable. Is that it? The last is commercial. Anyone do commercial real estate? Okay, so some of the lease write-off rules have been changed that go to taxes. They've been extended till the end of this year. unless they get extended again at the end of this year, we may see more commercial properties coming on the market for sale because the tax benefits are not as favorable for those owners. So that is it for our new rules and reforms. But I actually have something that I'd like to talk to you about that I think is even bigger than what's happening in Washington. And it's not something that gets written on paper, and it's not something that our legislators write about. It's something that is happening in American homes across the country as a result of the messages that Washington is sending us. So how many people here are parents or grandparents? Okay. Tonight, at 5 or 6 o'clock, millions of kids, just like ours, or grandkids, are going to sit at their dinner table and they're going to listen to their parents, like we did growing up. And they're going to be talking about their home, and they're going to be talking about their loan, and they're going to be talking about their bank, and they just may be talking about whether or not they want to continue paying their loan, whether they can afford to, whether it makes sense for them to do that. And the kids sitting at the table are going to listen to these conversations. And it's going to have an impact on them that's going to last way longer than our current not so great unemployment numbers or our current not so great GDP numbers. And in a sense, some of these new rules and reforms actually create a platform for that. For example, how many people have a closing in the next week? First of all, congratulations, that's great. Your buyers will be sitting at the closing table, and unlike buyers from 10 years ago, somewhere in their minds they will be thinking, you know, we're making this big commitment, I'm a little nervous about it, but guess what? There are these new loan servicing rules now. And they say that our bank is legally obligated to have someone sitting there 24/7 to answer the phone and respond to us right away if we decide that we want to short sell the house. Or if we decide, you know what, this loan doesn't work for us, we need a modification. And part of these new rules say that those banks have to wait at least 120 days before they can even file a foreclosure action. So your buyers are sitting at the closing table and saying, you know, worst case scenario, if something happens tomorrow, we just stop paying the mortgage and we can live here for 120 days. I'm not saying they're going to do that, and I'm not even passing judgment whether these are good rules or not. I'm just saying, you know, we need to be careful what we wish for, because we had what I hope was a temporary problem. We now have permanent solutions to what I hoped was a temporary problem. That's what Foreclosure Nation, my last book, Foreclosure Nation, was actually really about. It was, I wrote it starting in 2006, and it was about whether or not we are going to sort of become that, whether foreclosure has just become an institution in our country. These things are changing attitudes forever. We talk about how complicated foreclosures and finance and banking has become, yet the truth is that some of the rules that our grandparents or our parents may have followed are very simple and are just as good in terms of protecting you. How about something like, be careful who you trust? Or, if it sounds too good to be true, it probably is. Or, and this was something that my grandfather, who wanted to go to law school and then the Depression hit and couldn't, used to always tell me, don't ever sign anything without reading it first. Those are golden rules that probably could have protected people maybe as well as the Dodd-Frank Act. And guess what? It takes a lot less than 2,000 pages for me to explain them to you, and it costs a lot less than $30 billion a year. So as experts, my question here is, how do we simplify these new rules for people? How do we encourage values and attitudes for our kids and our grandkids and their peers and our neighbors they're going to engage Americans and empower them and inspire them to sort of get their financial mojo back and their independence and their accountability, and particularly in today's environment where, I mean, let's face it, everyone is so distrustful of the media and politicians and professionals who just want your business. We have millions of future generations right now actually deciding whether homeownership is even something that they want, or if renting is sort of their new version of the American dream. This is the first time ever that banks actually have more equity in American homes than Americans do. We have homeownership at the lowest level it's been in 50 years. And by some counts, about 40% of people who have lost their home say they never plan on buying again. So how do we as experts help to show Americans that they've regained over $1 trillion in home equity just in the past year, that millions are still rising above negative equity right now, and that homeownership really still is the best financial foothold for upward mobility for America's middle class. I see these new rules and reforms and the upcoming budget debates as opportunities for all of us as professionals to help re-engage Americans, starting with the people that we work for as buyers and sellers. Basically, so that these new rules and reforms and what Washington does can really reflect our collective values, can really protect future generations, and really represent what we want Washington to be doing for us. We are, I mean, realtors, absolutely positively, and in particular residential realtors, are America's most valuable resource in trying to accomplish this and trying to make sure that public perception about homeownership gets back on track to where it once was and where I think it should be. You are really uniquely positioned to help average Americans connect the dots between some of these new rules and reforms and their actual wallets, their home ownership, and their financial situation. So, you know, the question really is whether or not you're up for the challenge. And I think that by coming here today, you clearly are. So I want to begin and end by thanking you for coming and wishing you a great 2013.